All good? Fantastic. All right. Shall we get into it? Hi, everyone. My name is Brad Dunn. I'm the Key Relationship Manager here at Westbridge Funds. Thank you all for joining us today for our webinar on the Westbridge Total Return Fund. Just a bit of a real quick background on it. This fund was created out of listening to our investors over the years where they said, look, we love these long-term commercial funds, but we like to also find some stuff that might be a bit shorter in length, but still gives us an income, but more importantly, have a bit of extra capital growth and boost into it. So Damien and Alex, which are joining us today, put together a bit of a brains session, and we created this industrial total return fund as a bit of a test case. It was extremely successful. It was all about shorter term fund, had the important part of it's not going to be rolled over for a long period of time. People have a definite understanding of when the fund's going to end. And of course, they get that income, but also that nice boost of capital to go with it. And so hence the total return fund was formed. And so that's what we're going to talk about. Let's get into it. So start off by introducing our main people. Myself, I'm the Key Relationship Manager here. I look after all the investors across the group with my team. Any questions you have around any of the funds or education side, you can come to any of our team and we're happy to help. We're also joined today by Damien Collins, our chairman, who has over 25 years investment experience, former president of REWA, or as I like to call him, the human calculator. Welcome, Damien.
Hi, Brad. Good to be here.
And also we have Alex Lambert, our head of commercial funds with over 20 years experience in the industry across both the UK and Australia. He's held senior positions within private property portfolios, including one of the largest property service providers globally. Welcome, Mr. Lambert.
Thanks, Brad.
All right, so let's get into it. This webinar is being recorded, so anyone who does need to pop out, that's fine. We'll be sending out a link to those who would like to watch it later and those who can't attend. Also, feel free to send it through to your family and friends. Presentation will be followed by a Q&A session, so you can actually submit the question via the Q&A function, which is right here. So if everyone can see, you'll see that it's just a little bottom button on the bottom there. You just click the button, you type your question in, press send. We won't be answering questions until the end, but we'll try and get through as many as we can throughout the day. All right, let's get into it. So what is the Total Return Fund? Is what we're first going to be talking about. We're then going to be talking about why it's a good time to invest in commercial property. Of course, the most important part, how will the returns be delivered and what are you going to get back out of it? And of course, then we'll be running through with Alex Lambert, the fund performance and asset overview, followed by Q&A. Let's start off with the important bit as well, the disclaimer. Now, we just need everyone to understand that information is of a general nature, doesn't take into account individual circumstances. Always seek personalised advice before making a decision to invest. And for full information on returns and risks, please refer to the fund IM. Now, we will be sending out the IM to people post this for those that are interested in it, and we'll let you know later on how to get a hold of the IM. So stay with us. All right, let's start off by talking about Westbridge Funds Management. Now, we've been supporting investors for over 20 years. We've now got over $900 million in assets under management. And to date, in just the past 2 years, we've returned $55 million to investors. Also, more importantly, I'd like to also add that of our over 900 investors that we've got, they on average invest 3.8 times with us. So it's something that we do and are very proud of, that investors come back time and again to build their portfolios. Okay. As you can see, we're not just WA based. Yes, we are here in WA for those who are over east, but we do buy all over Australia. We made a bit of a decision some time ago that we liked industrial. We could see a bit of a wave coming, and so 5 or 6 years ago, we really started to buy heavily into industrial, as you can see. Mr. Human Calculator / global genius here has made the right call there, I feel, because industrial has absolutely taken off. Likewise, we also weren't a big fan of office back then, so we decided to be very picky with what office we decided to buy. We've got a bit of retail across the group as well, and we would like more healthcare. Up until now, it's been quite expensive to buy and wasn't really given the returns to investors, but now things are changing. Damien will be talking more into that, and also Alex further on. The management team's up on screen here, so you can see it's not just us here. We're surrounded by a great team of experts around us, but more importantly, I just want everyone to be aware that we've got a team of over 70 people here across the Momentum Wealth Group. It's not just the people on screen. We're surrounded by property experts in every single area. So we have got a great team, and we're all here to help make returns for the investors. So let's get into it. I'll hand over control to Mr. Damien Collins to start talking about the overview of the property. There you go, Damien.
Thanks, Brad, and good morning or afternoon or evening to everyone who might be on the webinar, even if you're watching later on. So, as Brad mentioned, we set up the Total Return Fund based on the feedback from our investors. Now, initially, we did an industrial total return fund a couple of years ago that just targeted industrial property. That was very, very popular. And then we set up this fund in 2022-23, and that in that financial year to target again value add properties. That was the feedback we had from investors, was that while the long-term funds are great and the income returns, that's not for everybody. Some of our clients wanted shorter term timeframes around that 4-year mark. And so we set up another total return fund, but this was not just industrial property, although we are certainly targeting that sector still. It was also targeting other assets and opportunities where we could see where we could value add to those properties. And that's critical. So we're not only getting an income stream through the journey while holding these assets are all targeted as something that we can value add, and that might be a short-term lease that might keep a lot of investors away from buying that asset. We know that with the capital behind us, and we know where the market conditions are, we know a decent amount about the tenant, we know that we can release that property, and generally at a much higher rate. But not only that, if in the case the tenant does go, we know we're buying in sectors and markets where we'll be able to get other tenants, certainly, I wouldn't say easily, but we're confident we can get tenants in those properties in a reasonable time frame at a good rent. So we have been targeting Australia-wide those commercial properties, and Alex Lambert will talk to you about those assets that we've already bought, and including the three most recent assets that we've got currently on the go at the moment. So we're targeting a total return of 10 to 12% internal rate of return per annum, and that's roughly made up of about half of that is going to be through income distribution. So if you're already an investor in the fund, you'd be getting distributions regularly through that fund journey, and we're going to put that up in July. Alex will talk about that as well. And then the rest is largely from capital gain. So we're looking at the value of these assets, what we can do to them, what we think we can sell them for, and then that balance will be targeted through capital gain. Now, there might be opportunities through the fund journey to pay some additional distributions if we can refinance or we sell an asset earlier. That's always a possibility, but most of the gain will be above the cash distribution, will be at the back end of the fund. And we're certainly, like anything, there's always risk, and we can't give any guarantees, but we're confident in the assets we've bought. And I'll talk through this presentation today where we see interest rates going and what that might mean also for where we see commercial property markets, and particularly where yields might start to end up. It's a wholesale only fund, so that means you need to have a wholesale certificate from your accountant, and that's 2.5 million of net assets or 250,000 net income, or put an amount of 500,000 in the fund. So if you're unsure about that, talk to Brad. He can point you back in the right direction to your accountant. I mentioned it's a value add strategy, and not only that, it's also geographically, we're not just doing industrial this time, although that's certainly a key target of the assets we're looking at. We're doing healthcare. We've got a couple of healthcare assets. We've got a pub. We've got some retail, some really good quality assets that we believe we can add value to, and it's 100,000 minimum investment. So a great way to get access and exposure to some really good quality assets across the country for a minimum investment of only $100,000.
I know I said we'll answer questions at the end, but I think explaining a bit around how the IRR works might be a good time to talk about it, since we are going through it now. So
IRR is, look, it's internal rate of return, and what that is a calculation of the time value of money over the journey of that entire investment. So it compounds. So what it effectively does is an average return, for example, if you had you got 48% return on your money over 4 years, that would be an average return of 12% per annum. You just divide 48% by 12%. But the internal rate of return compounds that annually. So to get 12% internal rate of return, you actually have to get, unless you're paying distributions equally months all the way through, and often you aren't because a lot of the return comes from the capital gain, it means your actual return will be higher in nominal terms than just summing the 4 years together. So there's some similarities between the two, but internal rate of return is a very common methodology used in the finance and property sector, and certainly, as I say, because of that compounding nature, if you're getting 12% internal rate of return, there's going to be more than 12% average return in terms of the actual money you get back in your pocket. So I mentioned there, look, that's a picture of our first asset that we purchased in Adelaide, and Alex will talk through that one. And I mentioned there, look, this is, again, I'll get Alex to talk to the what we're doing with each of the individual assets, but there's some really good opportunities. There's releasing, there's certainly re-rating, particularly with industrial rents that have gone up significantly. We've got some development potential in one asset in Queensland in a neighbourhood shopping centre where we can potentially add some value, not only leasing but maybe even development if things work out. So there's certainly the asset and in the fund, and the fund is really focused on value adding, but conscious that our investors do like some income. So we're not generally buying assets that are all vacant and then we're not going to get any return until right to the end. It's really about making sure there's a balance there of where we can get some income on the way through. As I said, we're paying around about 5 to 5.5 cents, and Alex will talk that through. That's going to go to 6 cents from 1st of July, but paying some income on the way through to get us some good returns on the way through, but also aiming to get some revaluation of the assets by value adding and certainly get a nice capital gain at the end. Interestingly, obviously we've had an incredible period of quite significant interest rate rises, which if you look back at what we've seen over the last 15 or so years, since the global financial crisis in 2007, interest rates have been in a downward trend, and they've plateaued, and they've even been continued down. And look, we obviously had in COVID, we had that Reserve Bank rate of 0.1%, which was we're not going to see that again. That's just not realistic. But I think sometimes people forget when we were in a low inflation environment. Remember, before COVID started, so there was no COVID. The economy was still pretty good condition in Australia. The Reserve Bank rate was 0.75%. I think that's something to keep in context. In a low inflationary environment, we certainly do expect interest rates to be significantly lower than they are now. Now, obviously, exactly how much lower we shall see. But of course, because the interest rates have gone up, that's made property less appealing to some investors, because they go, well, I can get 5% or 4.5% in a government bond or in the bank. And property's given me less return. But of course, we all know that money in the bank doesn't give you capital growth. You just get your money back plus the interest. And now we're starting to certainly see a switch in investor sentiment. Now, why is that important? Because we've been buying these assets when the sentiment hasn't been that great. And so the great thing is that through our acquisitions team, we've been getting access to off-market deals, but also we've been able to buy them at some really good rental returns. And where there's a rent reversion, where the rents are going to come back to market, significant, where they're going to be significant increase, the real yields are really, really strong, particularly considering where we anticipate interest rates going. Also, all our leases will have, if inflation does stay a bit longer, all the leases that we generally enter into will have, not all of them, but some of them will have CPI. Some have annual reviews. So rents are growing through that period. But and look, what has interest rates done to the market? Well, it's certainly really hit the office market significantly. Not only that, obviously all the COVID work from home issues. As Brad said, we don't have any office in this fund, and in our entire portfolio, the office components is 3%, very, very small of what we've got. And so that market's been impacted, but the ones that have remained strong are still the industrial market, because even though the capital rate value rates or the yields have softened a little bit. Rents are up significantly. We just did a deal in one of our industrial properties in Western Australia, and we got $170 plus per square metre for industrial property that 4 years ago might have been 110 or even 100. So that's offset in the industrial market any changes in the cap rates. And the retail sector still been in the right markets, has been still quite strong. Again, we've been targeting assets at a neighbourhood centre, a neighbourhood service centre, so things that people still need to go to in their local communities to buy goods from or services from, and kept away from product distribution, retail where they can buy online. And again, that's been the right call for us. And certainly those asset values are still remaining relatively solid, particularly the assets that we've got in Queensland and South Australia and Western Australia. The economies there are still pretty good condition, unlike Victoria, which is where you might be suffering a bit more in that market. The economies in those markets where we have these assets are still remaining pretty good. So certainly very confident. Now, what we'll see, as I said there, you can see in that next slide, rates have gone up significantly. We haven't seen a rate rise of this much in decades in that quickly, but that sentiment is changing, and we're hearing that from agents that the Reserve Bank have said now that they certainly don't see that they're going to raise rates. Anything, of course, is possible depending on what happens in the market, but there's certainly the market sentiment in the bond market is suggesting that rates will come down at some stage. I saw a forecast to say May. I think that's a bit too early. Other people have said not till next year. That might be a bit too late. But somewhere in this journey, based on the trends that we're seeing, it's likely that rates are going to start to come down. Of course, no guarantees. So we would expect that we're going to start to see demand coming back into the property market. Another thing too, it's important in Australia is we do have a very strong population growth, and that does help drive demand for industrial property. Every person who comes in Australia creates demand for distribution, retail, and even offices. So that's an important thing that we certainly follow. And right at the moment, this population growth in Australia is very, very strong. The other thing too we look at also is replacement costs. Now, building costs across the country have gone up significantly, in some cases 50, 60% above where they were 3 or so years ago. So that impacts where we might see rents and where we might see, because the replacement cost has gone up so much. That means the rents to stack up a new development have to go up the almost equivalent amount to make those projects stack up. So given the construction cost challenges and the delays in a lot of sectors, particularly as I say, that neighbourhood retail centre where we're targeting, and also the industrial markets, we are finding that demand is still really solid, and supply is simply not catching up. So we still see good growth in those areas. I mentioned there the interest rate environment. I really see, and there was an article in the Australian Financial Review, and that's wasn't written by us, but it was but certainly something that we feel right now is we've got the big entities, the big listed groups still selling off a few assets because they've got to meet some redemptions, and they've got some challenges, and they're sitting on the sidelines. In fact, two of the three assets that we're going to mention today in the healthcare sector were from one of the big listed groups. And so we think there is a limited window of opportunity before that weight of money comes back into property. Once people start to feel certain, I think that'll happen before the rates start to come down, that people feel certain, you know what, rates are not going to stay where they are. They're going to come down. I need to move my money out of the government bonds or out of the bank. That's where I think we're going to start to see that competition come back in, and that will mean yields will go down, prices will go up. So I really think we're in that window that will probably only be here for 3 to 6 more months, where the competition will be lower. I think the back half of this year, we'll see the big institutional groups. We're going to see a lot more money start to flow back into property, and that means that the yields will go down and prices will rise. So I think there's a great time to be opportunistic, and that's one of the reasons we did set up this fund in the last couple of years was because of that. We saw that there was opportunistic buying, and in fact, the value of the assets have already risen. And Alex can, on the ones we already hold, and Alex can talk to you about that. So. Yeah, it's actively increasing value on these assets. We're targeting industrial, medical, neighbourhood retail, non-discretionary essential services, which I've spoken about, those local service centres, particularly in the strong economies. People are still spending, and WA and Queensland, their economies are still going particularly well. South Australia's solid, never booms, but it's always solid. So there are some great counter-cyclical opportunities out there in the market at the moment. So look forward to coming back to answer some of your questions. But on that note, I'll hand it over to the head of our commercial funds, Alex Lambert, and he'll talk through in more detail on the assets that we currently hold and obviously the current assets that we're purchasing.
Thanks, Damien. I'll jump straight in on the funds there, which leads in nicely from your slide. So effectively, as the sort of mandate, we've been looking at a mix of the value-add assets, properties where there's potential for capital improvement and leasing in the near term to drive that uplift, but also income plus assets where perhaps there's a longer income stream, but opportunities through leasing and further down the line where we can add value. And the key, I think, to establishing any fund is the first asset. Our mandate was to secure an asset that was both income producing from the outset, but also had that ability to get some growth straight away. And Simon Worth, our head of acquisitions, found exactly that in the Hampstead Hotel, which is situated 4.5 kilometres from CBD in Adelaide. And I guess there's a few reasons why we like this asset, but going straight into the sort of tenure of it, it's a JV between First Choice, which is effectively Coles, and ABC, which is a national tavern operator. The Coles being the First Choice, being the Coles bottle shop in yellow here, and the tavern highlighted in blue. During due diligence, the team were very active in speaking with the tenant, and were able to extend the lease terms so that it was a longer tenure, expand the tavern to the area just coming in there, and also increase the rent. This has effectively increased the value. In return, we've put in some capital to do a refurbishment of the tavern, and that's driven the value once it's completed by about 26% increase. What we didn't budget for in the acquisition, we've got 3 small retail tenancies here. We think there's potential to drive further growth. We've had some strong interest. One tenant has unfortunately fallen through, but we're now speaking to a few other tenants and are pretty confident in leasing that up. So overall, we've managed to get a long-term income stream for the first asset, which has capital growth from the outset. Our focus then shift to Queensland. We really like the macroeconomics in Queensland. Interstate migration is high, infrastructure spend is huge, and also there's the build up to the 2032 Olympics. So look, there's a lot going on over there. The Lisson asset here in Benjamin Place, it's a last mile refrigerated logistics asset close to Brisbane Port, which is very sought after by tenants. It is leased for now, and it's under rented. So our strategy really is to, towards the end of the fund term, reset that lease, reset the rent to market, and in doing so, driving that income and value in that asset. To the southwest of Brisbane, we purchased last year Cinnamon Park, which Damien mentioned. That was only in December. Now, we purchased this with a vacancy in the corner and a few short-term leases, and it needed a little bit of modernisation as well. So we've only had this a few months. We've secured 2 leasing transactions already, and we're in advanced negotiations to lease the corner tenancy to a general practice medical centre. We're also looking at some potential cosmetic refurbishments and a few other leasing deals in that centre. Again, really focused on driving that income and extending the value in that asset. Over to Western Australia, home turf for us. Look, these assets Damien just mentioned, we're now unconditional, subject to settlement. They're a portfolio of assets. We think we're buying these at a significant discount to their valuations 18 months ago. Joondalup is a private hospital, and the one in South Bunbury, General Practice Medical Centre. And look, they're both extremely busy operations. And in Joondalup, we think they're in this sort of growing medical sector, there's potential for rental growth. There's a market review in 2025, which can't go backwards. And in South Bunbury, the team's spoken to the tenant during due diligence, and they're keen to sort of do some internal refurbishments and be able to expand their operation. We're talking on this now, and there's potential to undertake improvements in return for improved lease terms. Looking ahead, we have the Kensington asset in Victoria. That's in due diligence. We're working through our inquiries at the moment just to make sure there's a right fit. But we're also looking to target quite a few further value-add assets. We've created this great blend of income with good prospects for growth so far. And this provides a good platform, we think. The leasing activity has effectively put us ahead of forecast. We may be able to consider both increasing the distributions. As Damien mentioned, we're targeting 6 cents per unit from 1 July. There may be potential to improve this on the back of leasing activity currently, but it also gives us that platform to look at some calculated risk on the next assets to try and create even more growth as we go on. Look, we'll keep you updated on the fund and the opportunities as they arise. But I think we're hopeful we can get some great assets to add a few more to close out the fund towards the end of this year. And I'll hand you back to Brad for any questions.
Fantastic. Thank you, Alex and Damien. That was really well done. Shall we move on? I'll just put the button here. Okay, so for those that are really eager, you can actually scan the QR code right now to register interest, and we will be able to run you through everything, send out the IM and answer any questions you have in more detail. However, we will also be sending out an email to everybody just with some more details on how you can do all that for those who aren't as tech savvy. So do not worry about that. We'll leave it there for a bit. We'll move into the Q&A now. So we will start by looking at some of the questions here. Okay, so shall I start with basically at the top? This one's probably for Alex. Do you buy land and build and then rent, or buy already constructed properties?
Good question, Brad. I guess the focus of the fund is to buy existing assets and look where we may be able to improve them. At Cinnamon Park, for example, there's a potential development upside that we may be able to add to the centre, but the general sort of aim of the fund is to look to buy existing assets rather than sort of outright straight development.
Fantastic. All right. We'll continue along that line. So for Alex again, what is the guarantee you're offering to return the capital in the event the company encounters a loss?
Well, I don't think there's any guarantees. Look, we've outlined what our target returns are. In the IM, we put through a lot of work into our assumptions, and as sort of Damien went through in his slide, the diversity of state, sector, income, and tenants. So the real design about that is to make sure we're not putting all our eggs in one basket, so that sort of de-risk it to a certain extent. There's always risk where you're trying to undertake leasing strategies and value add, and we're sort of going through that in a calculated process. Where we sort of know the markets, where we're confident that the tenancies or the properties are suitable to a whole host of tenants. So our focus really is to de-risk it by having that sort of appeal to wider audiences, knowing the market, and being able to lease up and execute our strategies.
Yeah. Excellent. And Pete, I'm not deliberately missing you, but I think it'd be a smart one to move straight into one for Damien. Are there any loans on the properties, i.e. gearing? Because that will also be talking about loan recourse as well, I believe. So if you want to cover off on that one.
Yeah, thanks, Brad. Yes, there are loans on the properties, and look, that'll vary by asset. Where around about 50% is our to 55 is our target gearing. But if an asset has a shorter lease period, the lenders might require us to perhaps put a little more in terms of equity, but our overall portfolio target is around 50 to 55%. So sort of gearing can obviously magnify the returns both ways. If the assets do as we hope they do and plan for, with no guarantees, of course, gearings do help magnify those returns, but it does impact it if the values happen to go the other way as well. So always be conscious of that. But we think the gearing ratio of 50 to 55% is around the market standards for these types of assets and funds.
Yeah, excellent. I'll go back to Pete now, and I'll cover on if you like, nice and quickly. So in terms of the wholesale investor, and for those who've already registered, you don't need to register again. That is fine. Wholesale investor, Damien briefly touched on, is one of three things, actually. You can either be covered by what's called the income test, where you have earned gross income of $250,000 on average over a period of 2 years. Or you have net assets of $2.5 million. And the final one is if you're willing to put more than $500,000 into any one investment, which to me is a bit of common sense, because if you've got that sort of money to throw in, you're probably covered off on the other two. The way that's done is your accountant that you would have signs off to confirm that that's the case. It's just an ASIC requirement for certain funds as per our licensing rules. If you'd like more information on that, I'm happy to send it out. We've got plenty of blogs and information. Our lovely marketing team covered off on that in the past, so we can send that through to you if you need. Going back to Alex Lambert, what asset management fees and success fees are payable, and do you pay them or put them to a loan?
So fees we get secure on the asset management fees are 0.75% of the assets under management, and the returns that we state are after those fees, so they're net of those fees.
Fantastic. Okay, so I got one from George. Damien said something that got me thinking. You've been buying properties as opposed to plan to be buying. So I guess the question he's asking is, what's the life cycle of these funds and how does it work? So does Westbridge first take on debt to purchase properties and then ask people to invest? So Westbridge can pay some or the debt required, or how does that all work?
Thanks, George. No. So the way it works is we buy assets through our contacts, through the capital transaction teams, and then they go through a period of due diligence. So Alex mentioned we've got one in Kensington and Victoria that is still going through that phase. So we haven't 100% committed to that asset. The contract will say it's subject to us being satisfied in all manners. And there's a lot of work. I think many investors might be amazed at the amount of work that not only Alex Lambert as the head of commercial funds, but also the acquisitions team do. There's a lot of consultants involved. You've got to make sure so many things to cover, legal reviews of the leases, everything that we do. So we'll buy it subject to due diligence. So right now, the two assets in that we have gone unconditional on, the Bunbury one and the Joondalup one, the healthcare assets, we've only just got unconditional on those. We've still got a period to settlement. So what happens now is what we're doing at the moment is we raise the money from investors. At the same time, we'll be out there talking to the lenders, and we've already been doing that. Lenders are keen to support us and support our funds, so we'll get loan offers from them, and then on the day of settlement, the money from investors will be used to settle on that asset, and the money from the bank we use to settle the balance of it. So it's really no different, I guess, if you were buying a home. You buy it, the contract, you've got your deposit, and then you obviously set up the balance and get the money back from the bank when it comes to settlement.
Fantastic. I think that was well covered. Thank you, Damien. I've got two here from Brad and Sean in terms of the length of the fund. That's an easy one I can cover off on. It's essentially a 4-year fund in total. However, it has already been running for 1 year, roughly 1 year, hence the 3 assets that are already in the fund. The plan is to be selling down all the assets by the end of the fund, so it could go over a couple of months depending on where we're at in the sale process, but essentially only 3 years left on the fund. As I mentioned at the beginning as well, quite an important note, it's not like a lot of the longer term commercial funds which could roll for a much longer period of time. The strategy here is to definitely sell out these assets, so you know that you've got a rough timeline of another 3 years left within that fund. Good question from Roger here. I'll take back to Damien around the wholesale investing. Federal government's proposing to raise the bar for wholesale investors' eligibility. Do you see this eventuating or having much impact?
Thanks, Roger. Yeah, look, there is talk around the market that they might increase. It's likely there will be some changes to the wholesale investor criteria, simply because the thresholds have been in place for almost or around 20 years. So there's no that there will be some changes. Look, it's certainly, we have a retail license. We can offer, this product is not for retail investors, which means all investors. We've limited it to, based on the feedback from our clients as to which of our investors might like this sort of product. We limited it to wholesale only investors. And so if these changes come in, it won't affect our business. We'll still be able to provide our opportunities to our investors. We might switch some of these types of products to retail in the future, where all investors can invest, but at the moment this is wholesale only. Will it have much impact on the market? I don't think so. Some of the smaller syndicators might be impacted because a lot of their investors, they have wholesale only licenses. They may not be able to be in the market, but certainly the bigger guys and institutions are still out there, and they'll have plenty of money, and they won't be impacted by this. So I don't think it'll have any market impact in terms of capital values and yields. I don't think it'll have any impact at all.
I'd also add to that they do have a lifespan of 2 years. I can't see it being retrospectively pulled back if they do make any changes. So
no, 100%. Yeah, 100%, Brad. Yeah. So if any changes come in, again, no guarantees in this world, of course, but it would almost certainly grandfather in the existing people in existing funds. And there's even talk they might even grandfather people in already classified as wholesale with a certificate from their accountant into the as staying as wholesale, even though they technically wouldn't qualify, and that might be for a period of time. So, so look, all these things, who knows if and when they will change. Certainly, from our point of view, we'll still be able to offer these great opportunities for investors in the longer run. But it certainly won't have any impact, I think, on capital values and asset valuations. I don't see that happening at all.
Excellent. Next question, very common. It's actually one of the 3 questions beforehand. Basically, Damien, if you want to cover off this one, what percentage of equity is bought in by Westbridge, i.e. how much skin in the game do we have?
Yeah, absolutely. So we'll invest in every single fund, and the extent of that investment will be depending on how much our investors want. We certainly don't want to crowd out, but it's not just myself as well as the business, but a lot of our management team invest in the funds to the extent that they can. So it'll vary by fund, but look, absolutely, we're our ultimately how much we get paid from the fund is based on the performance of it. The asset values, we get a percentage of the asset value. So if we don't grow the values of the assets, well, we don't see any growth in what we're paid. And there is, you'll see it in the IM, there is a performance fee if we hit a certain target. And all these fees are disclosed in the information memorandum. So we're certainly aligned with our investors, not only the fact that we invest ourselves, but also ultimately how much we will get paid is going to be determined on the success of the investment. So it's definitely alignment with the investors.
100%. And I can also definitely confirm that there's a lot of us personally that have gone into this fund already. So yes, we are a fan of it. Good question here from Peter. I think it might actually be the opposite. I'll leave this one for Alex to reply to. Some funds have a cut-off point, for example, fully subscribed. Is it possible or feasible to take an oversubscription and use the additional funds to pay down the loan, resulting in a larger income return to investors?
Louis, depending on each raise as we go through, we generally have a balance between equity and debt. We do have the ability to take over subscriptions if we have more than required. In our previous raise, we did take a little bit more than we needed because there was that oversubscription, but we then rebalanced that through the latest raise. So look, we can do it. Sometimes there is the ability to look at paying down debt. But we try and get the metrics so that we're happy with that on a returns basis so that it balances out with the IRRs that we're targeting.
Excellent. Next question. What percentage do you reckon the fund will terminate as scheduled versus getting rolled over? And the second question is, does the fund hold key man insurance on the key individuals like Damien and Alex? Who would like to cover that one? I see Damien smiling, so it's all his.
I can answer that one. So look, the fund has a time frame, and then basically the plan will be at that stage to sell down the assets and return the money to investors. But like all funds, there is potential there where the fund may be extended. Now, we've gone into this fund with the time frame in mind, and we want to deliver that time frame to investors. But obviously, if something happened in the market and we thought, well, this is not a great time to sell, or some of the assets we might have to hold back some and not the others. That's always a possibility, but that's not our objective here. Our objective is to maximise the value of the assets, get them to the point where we think they're in a good saleable position, sell those assets and return the money to investors. But like anything, it's like, again, I'll relate it back to your house. You might want to put your house on the market, but if the market's down, you might say, I might have to defer that. No, and again, I don't foresee, of course, the market being down in the next couple of years, but of course, anything's possible. So that's certainly not our objective, is to keep rolling it forward. Our objective is to meet the mandate of the fund and return the money to investors. In terms of key man insurance, the fund, obviously we've got $900 million of assets under management, and the business itself does hold key man insurance on me if I happen to pass on into the next world, which I'm not planning to do. But the business as a whole does. But you know what? To be honest, I'm very confident. If I went and lived on an island somewhere, not that I intend to, that I went and lived on an island somewhere. The team I've got here at Westbridge and Momentum Wealth are fantastic. You've met Brad and Alex today, and sure many of you know our CFO, our head of cap transactions, head of developments. They would carry on very well without me, and I know that the skills they have, and the business wouldn't miss a beat. But I don't plan on going anywhere on holidays or the next world. But in the unlikely event that I did, the business will be fine and without me.
Fantastic. Can I also add back out like that? Can I also add back just on that fund termination comment as well, just to let you know that we do have multiple assets. So it's not to say that we would just sit on the funds once we sell down one asset. We'd be returning capital back to investors as soon as possible. Oh, yep. And I'm getting the wind up for one more question. So let me just have a quick look. Okay, so Roger, you've got two here that are quite combined. Is there any link between new fund and earlier Westbridge Total Return Funds, and how have the earlier funds been performing? I'll quickly answer that one. What I would say is no, there is no link between prior funds and this fund. They're all separate unit trusts. They all are separate, as much as we would love to, because I reckon everyone would love to get a bit more into that original Industrial Total Return Fund. It's killing it. But yes, no. So unfortunately, every single fund is standalone. So everything within the Total Return Fund, though, all the assets that are already in it, plus future assets, will be included. So the unit holders do get access to all the assets within this fund, but they're not linked to any other funds. And as for how other funds have been performing, we've got 20 plus years of a really good track record, plenty of case studies, results, the whole bit. So we're happy to provide heap of information on that. It's all through our website. If you come through to us, we can send out any information you like on that. I think we've got one question left, so let me just run that one quickly. And do unit holders have to vote on an extension, and how does the voting process work? Lambo, do you just want to quickly cover that one?
Well, I guess looking back to what Damien said, this fund isn't set up to have an extension. We're targeting to sell down the assets as a total return in 3 years' time. So effectively, that's the plan. There isn't necessarily a vote, and the only reason we sort of deviate from that is market conditions, as Damien alluded to. But we're very focused on sticking to that time frame, resetting the assets, and divesting those according to the timeframes.
Fantastic. Well, thank you, everyone. We do have a list of another 12 questions here that we didn't actually get time to get through, so we will endeavour to go back to those people. However, you're able to contact any of us at any point. We can run through any more questions that anybody has. Thank you, Damien. Thank you, Alex. Very well covered.
Thanks, Brad.
Thanks, Brad.
No worries. All right. Thank you, everyone, and hope you enjoyed the show. Thank you.